The what if the banks you trust are risking your money? Let's expose the hidden dangers in finance right now. Today we'll break down risk, hedge funds, systemic threats, regulation, and bold new ways to protect your future. Get ready for real-world examples that will change how you see money forever. How much risk would you take if you could win big or lose everything in seconds? Welcome to the world of hedge funds. Hedge funds, which are for accredited investors and family offices, can take on a lot of risk and use leverage. That's because it's assumed their investors are experienced and have professional advice. Take Citadel, for example. This well-known hedge fund uses complex trading strategies and often borrows money to try to boost returns. This can mean big gains for wealthy clients, but it also means they could face huge losses if things don't go as planned. The collapse of long-term capital management in 1998, a hedge fund with Nobel Prize winners on board, shows just how much risk these big connected funds can bring to the whole financial system. And what if the next financial disaster is something no one can predict? Enter the world of black swan events. Traditional risk models often fail to account for rare, high-impact black swan events, unpredictable events with severe consequences. The 2008 crisis, fueled by the unexpected collapse of the housing market, stands out as such an event where many models underestimated the possibility and impact of such a widespread decline. The COVID-19 pandemic in 2020 could also be considered a black swan event for financial markets and the global economy. While health risks were known, the scale and widespread economic disruption caused by lockdowns and supply chain issues were largely unforeseen by traditional economic and financial models. This event again highlighted the limitations of relying solely on historical data to predict future extreme events. Could one bank's failure crash the entire global economy? Let's uncover the domino effect of systemic risk. The 2008-2009 financial crisis highlighted the importance of macro-prudential regulation, focusing on interconnected institutions and the risk that one failure could trigger a system-wide collapse. This stands in contrast to micro-prudential regulation, which focuses on protecting individual investors. The collapse of Lehman Brothers in 2008 is a stark illustration of systemic risk. Lehman was deeply interconnected with other financial institutions through complex instruments. Its failure triggered a domino effect, freezing credit markets and leading to a global financial crisis. In response, regulations like the Dodd-Frank Act introduced measures to increase transparency, capital requirements, and oversight of large institutions to mitigate systemic risks. Stress tests are now a regular part of macro-prudential oversight, and close attention is paid to how they assess whether banks would fare under severe economic scenarios. After disaster strikes, how do we measure risk in a world where everything is connected? Since the 2008-2009 financial crisis, greater emphasis has been placed on developing more elaborate assessments of macro risk, including stress tests that evaluate financial institutions' resilience to various economic shocks and their interconnectedness. The European Banking Authority, or EBA, conducts regular stress tests on major European banks, and these are followed closely. These tests simulate adverse economic scenarios, like a sharp decline in GDP, a rise in unemployment, or a fall in housing prices, and the adequacy of banks' capital to absorb potential losses is evaluated. The results are made public, which increases transparency and confidence in the banking system's stability. Imagine the next economic shock. Could you protect your job? Let's explore new ways to shield ourselves from labor market risks and picture the possibilities together. Just as we hedge against risks in oil or crops, imagine if we could protect ourselves from losing a job or facing a pay cut. Creating these protections is the next big step in personal security. Unemployment insurance acts as a safety net in many countries. If you lose your job, it's there to support you, helping when you need it most. This support gives you time to search for the right job, not just the first one available. It helps you stay stable even when life is uncertain. Wage insurance is a bold new idea. If you lose a high-paying job and take a lower-paying one, it helps fill the gap, softening the blow and giving you time to adjust. If wage insurance becomes common, it could help people bridge lost income, making career changes less risky and giving you time to find a job that truly fits your skills. Though not widespread yet, some places are testing wage insurance. The conversation is just beginning and new ideas are emerging. Smart risk management encourages people to take chances and innovate. The right tools can make all the difference. Tools like wage or livelihood insurance inspire people to pursue education and bold careers, fueling innovation and economic growth. A safety net makes it easier to learn specialized skills, even if they might become outdated. It gives you confidence to adapt as the world changes. Imagine studying robotics or another specialized field. There's always a risk your skills could become less needed, but the rewards can be great. With strong wage insurance, you'd feel safer taking that leap. If your skills ever became outdated, you'd have support while you retrain for a new career. When people feel safe to take risks and develop their talents, innovation grows and the workforce becomes ready for anything. So as investors, we must ask, what's the true cost of risk? And more importantly, how can we transform uncertainty into opportunity? The world's financial system is more complex and interconnected than ever. Robust regulation is essential, but so is the courage to innovate. Traditional models can't predict every storm, but they can help us prepare. Forward-thinking investors look beyond the obvious. They seek out new tools, new protections, and new ways to hedge against the unknown. Are you ready to rethink risk? In a world of uncertainty, those who adapt, question, and innovate will shape the future of finance. The next move is yours.